The Federal Reserve has been thrust into the spotlight once again, as its leaders grappled with the tricky task of navigating a delicate economic landscape. In the weeks leading up to their latest policy meeting in Washington, the central bank's officials found themselves deeply divided over the appropriate course of action. On one side, Chair Jerome Powell and a vocal contingent were convinced that bold, decisive action was needed to steer the economy away from potential danger. The August jobs report had been decidedly underwhelming, sparking concerns that the labor market was starting to show worrying signs of weakness. Coupled with easing inflationary pressures, this was enough to sway Powell that a hefty half-percentage point rate cut was the prudent move. Arrayed against him, however, was a sizable minority who favored a more measured quarter-point approach. These officials, including the lone dissenter Governor Michelle Bowman, worried that overshooting could jeopardize the hard-won gains on inflation. In their view, the economy was not yet flashing the kind of distress signals that would typically prompt such an aggressive response from the Fed. This internal tug-of-war played out in the days leading up to the momentous September 18th meeting. Powell, with his formidable power as chair, ultimately emerged victorious, persuading all but one of his colleagues to sign on to the bolder, half-point cut. But the battle lines were drawn, and the debate laid bare the delicate balancing act the Fed now faces. As David Brooks, the esteemed New York Times columnist, might observe, the Fed's great recalibration is a saga rife with high-stakes drama, competing worldviews, and profound implications for the lives of everyday Americans. It is a story that speaks to the very heart of the central bank's dual mandate to maintain price stability and foster maximum employment. And in these uncertain times, the stakes have never been higher. It was against a backdrop of increasingly unsettled economic conditions that the Fed's policy deliberations unfolded. The sharp deceleration in job growth, culminating in the August report that showed a mere 130,000 positions added, had set off alarm bells within the central bank. This was a stark contrast to the robust, double-digit monthly gains that had characterized much of the post-pandemic recovery. The economy wasn't flashing the kind of obvious warning signs that would typically prompt an aggressive response from the U.S. central bank, Brooks notes. But for Powell and his allies, the trend was unmistakable. A notably weak run of jobs data, including the August employment report the previous Friday, had convinced Chair Jerome Powell that a bigger-than-usual rate cut was necessary to ensure against rising risks to the labor market. The concern was that this softening in the labor market could portend a broader economic slowdown, potentially imperiling the hard-won gains of the past several years. As Brooks observes, the priority Powell has put on keeping the economy near full employment so long as inflation is cooling was a key driver behind the push for bolder action. Yet, not everyone was convinced that the economy was teetering on the brink. The minority faction on the Federal Open Market Committee, FOMC, saw the data through a different lens. In their view, the underlying fundamentals remained relatively sound, and the risks did not yet warrant a dramatic departure from the committee's recent pattern of quarter-point adjustments. A sizable minority penciled in just 75 basis points, suggesting support for 3 smaller moves. Brooks writes, underscoring the stark divide within the Fed's ranks. This group, which included the dissenting Bowman, believed that a more cautious, incremental approach was necessary to avoid undermining the hard-fought progress on inflation. Inflation, of course, has been the other crucial consideration weighing on the Fed's deliberations. Here, too, the central bank's policymakers found themselves grappling with a complex and rapidly evolving landscape. In the weeks leading up to the September meeting, a pair of inflation reports had shown price pressures continuing to ease, which Brooks notes sealed the deal for Powell's push toward a bolder rate cut. The data suggested that the central bank's previous actions were beginning to bear fruit, easing the concerns of those who had worried that the Fed was moving too hastily to tame inflation. After a surprising pickup in inflation in the first quarter of 2024, which startled many Fed officials, he patiently held rates steady until gaining confidence that price pressures began easing again, Brooks observes, highlighting Powell's deft navigation of a treacherous inflationary environment. Yet, as Brooks points out, the battle against inflation is far from over. The minority faction on the FOMC remained concerned that a more gradual approach was necessary to cement the progress made thus far, lest the central bank's actions risk tipping the economy into an unwanted recession. Some lawmakers complained he was putting the economy at risk, Brooks writes, underscoring the intense political pressure the Fed faces as it seeks to chart a delicate course between the twin imperatives of price stability and full employment. Underlying this high-stakes drama is the enduring question of the Fed chair's authority and influence. As Brooks observes, the chair always has enormous power, and Powell has demonstrated his ability to wield that power adeptly in recent months. From signaling a potential peak in rates in December 2023, to patiently holding steady in the face of surprising inflationary pressures, to ultimately opting for a bold, half-point cut, Powell has shown a remarkable ability to steer the course of the central bank's policy decisions. There is a clear success story in Powell's ability to get all but Bowman on board, and he is a more powerful chairman now, Brooks writes, underscoring the chair's growing influence within the FOMC. Yet, this concentration of power also raises questions about the delicate balance within the central bank. As Brooks notes, a number of officials speaking in recent days have signaled they're likely to support quarter-point reductions moving forward, but left the door open to another large cut. This suggests that the internal debates within the Fed are far from settled, and that Powell will need to continue to navigate the complex currents of economic data, political pressure, and competing ideological visions if he is to maintain his grip on the central bank's policy direction. One of the key factors that tilted the scales in favor of Powell's preferred half-point cut was the notion of risk management, the idea that the central bank should act preemptively to head off potential threats, even if they may not have materialized yet. As Brooks explains, risk management, a strategy embraced under former chair Alan Greenspan, seeks to head off potential threats, even those that appear unlikely to materialize. And with a half-point cut leaving the Fed's benchmark rate still in restrictive territory, the cost of a large insurance cut was viewed as low by several officials. This approach reflects a shift in the Fed's thinking, moving away from the more rigid, data-dependent framework that had characterized its recent policy decisions. Instead, Powell and his allies have embraced a more flexible, forward-looking stance, willing to act decisively to safeguard the economic expansion. Even after the 50 basis point cut, I believe the overall stance of monetary policy remains tight, Minneapolis Fed President Neel Kashkari wrote in a September 23 essay, explaining his support for the larger move. But this shift toward a more proactive risk management posture has not been without its critics. As Brooks notes, some lawmakers complained he was putting the economy at risk, a reflection of the delicate balance the Fed must strike between its own assessment of economic conditions and the political realities it faces. As the dust settles on the September FOMC meeting, it's clear that the internal deliberations within the central bank are far from over. The lively debate that unfolded in the weeks leading up to the decision, and the narrow margin of support for Powell's preferred course of action, underscore the deep divisions that continue to simmer beneath the surface. There was active deliberations at the meeting, Kashkari said in a September 23 interview on CNBC. There was a lot of discussions, obviously, leading up to the meeting. Atlanta Fed President Raphael Bostic echoed this sentiment, noting that the 2 weeks before every FOMC meeting is a time of intense discussions. As Brooks observes, if you want to get coordination, and you want us to all be able to coalesce around one course of action, it's going to require a lot of communication, engagement, and we do a lot of that. This ongoing debate reflects the weighty responsibility the Fed faces as it navigates the treacherous terrain of an economy in flux. The central bank must grapple with the delicate balance between price stability and full employment, all while contending with the myriad political and economic forces that pull it in different directions. As Brooks concludes, the Fed's great recalibration is a saga rife with high-stakes drama, competing worldviews, and profound implications for the lives of everyday Americans. It is a story that speaks to the very heart of the central bank's dual mandate to maintain price stability and foster maximum employment. And in these uncertain times, the stakes have never been higher. The outcome of this debate, and the path the Fed ultimately chooses, will have far-reaching consequences for businesses, households, and the broader economy. It is a drama that will continue to captivate the attention of policymakers, economists, and the public alike in the months and years to come.